Most people think the old world is just under stress. I think it is being rewritten. The danger is not what everyone sees on the surface. The danger is the slow shift underneath the headlines. And the richest investors I know are not reacting to the news. They are preparing for the map itself to change. If you want to stay close to the signals that usually reach the public too late, stay with me here, because this is one of those moments when quiet preparation matters more than loud opinion. When I talk about a different world order, I am not talking about some movie plot or a dramatic slogan. I am talking about the system that decides who lends, who borrows, which currency people trust, which country writes the rules, and what happens when that trust starts to thin out. Most people only notice the surface events. They see tariffs, elections, wars, inflation, or stock market swings. What they miss is that these are often symptoms of a much deeper shift. I have spent a big part of my life studying how countries rise, how they peak, and how they decline. I studied this because I needed to. Markets forced me to. Pain forced me to. I learned very early that if I only looked at quarterly earnings or next month's interest rate decision, I would miss the larger machine moving beneath everything else. That larger machine is not hard to understand once you strip away the jargon. Every world order rests on a few pillars. One country usually becomes the strongest in wealth, military power, education, technology, capital markets, and trade. Its currency becomes the money that other countries want to save in. Its bonds become the asset others trust. Its rules shape the highways of global commerce. And then, over time, success plants the seeds of excess. That is what happened after World War II. The United States came out of that era with enormous strength. In 1944, the Bretton Woods system tied the global order around the dollar. In simple terms, the dollar became the center of the room. Even after the gold link broke in 1971, the dollar stayed dominant because America still had the deepest markets, the strongest institutions, and the broadest military reach. For decades, that gave the United States a privilege few empires ever had. It could borrow more cheaply than others because the world trusted it more than others. That privilege is still real, but it is not permanent. No reserve currency lasts forever. Before the dollar, it was the British pound. Before Britain, it was the Dutch. Before that, it was others. History does not move in a straight line, and it does not hand out permanent advantages. It gives long cycles. Then it tests whether the people inside those cycles understand what is happening before the cycle turns. I learned this lesson the hard way long before most people knew my name. In 1982, I was so sure I understood the debt crisis that I made a huge bet and got crushed. I thought the system was heading one way, and I was wrong. That mistake was one of the best things that ever happened to me because it taught me humility. It taught me to stop thinking in certainties and start thinking in probabilities. And the richest investors in the world think the same way. They do not wait for proof that everyone agrees on. By then, the price of safety is already higher. So when I say they are preparing for a different world order, I do not mean they are all making one dramatic move. I mean they are adjusting for a wider range of outcomes. They are thinking about what happens if the dollar remains strong but weaker than before. They are thinking about what happens if inflation stays sticky, if debt keeps compounding, if trade becomes more political, and if capital starts moving along lines of power instead of lines of efficiency. That is a different world, even if the skyline outside your window looks exactly the same. Right now, the obvious story people tell is simple. They say the economy has problems, but it always does. They say America is too innovative, too wealthy, too powerful to truly lose its place. They say the stock market still works, the treasury market still works, and the dollar is still dominant, so all this talk about a changing order must be overstated. I understand that view. On the surface, it sounds reasonable, but it leaves out the arithmetic. The United States now carries roughly $39 trillion of debt. That number is so large, most people stop feeling it, so I try to translate it into something real. The government is not just carrying a big balance. It is also running very large annual deficits, around $1.9 trillion in 2025 by Congressional Budget Office estimates. That means it is still spending far more than it takes in, even without a major war on the scale of the past or a crisis like 2008 hitting all at once. Then there is the interest bill. In fiscal 2025, net interest on the federal debt was around $970 billion. Think about that. Nearly $1 trillion just to service past borrowing, not to build bridges, not to fund new science, not to improve schools, just to pay the carrying cost of old promises. And once interest costs get that large, the machine becomes more fragile because more borrowing is needed just to support the borrowing already there. This is where many people get lazy with the story. They assume there is an easy escape hatch. If growth slows, the central bank cuts rates. If markets wobble, liquidity comes in. If deficits rise, buyers will show up. But when debt gets too large relative to income, your choices become ugly. You can cut spending, which hurts people and slows growth. You can raise taxes, which creates political conflict. You can print more money and buy time, which weakens the currency and eats purchasing power. Or you can try some mixture of all three and still upset everyone. That is why I keep saying this is not just an economic issue. It is a political issue, a social issue, and increasingly a geopolitical issue. Debt always creates a relationship between debtors and creditors. Inside a country, that means fights over who pays. Between countries, it means questions about who wants to keep lending and on what terms. When those tensions rise at the same time, the world order starts to change from several directions at once. If your savings depend on one government, one currency, and one set of assumptions about the future, are you investing or are you simply trusting yesterday to repeat itself? I want to slow this down because this is where the deeper mechanism sits. The reserve currency of the world is not just a symbol, it is a source of power. When your currency is the one everyone needs for trade and reserves, you can borrow more easily, sanction more effectively, and run deficits for longer without feeling the same pressure other countries feel. But that privilege weakens over time if the debt grows too fast, if the currency is used too aggressively as a political weapon, or if rivals build enough size to create alternatives. The dollar is still the biggest reserve currency in the world. That part is true, but its share of global foreign exchange reserves has declined from around 72% in 2001 to roughly the mid-50s by 2025. That does not mean the dollar is about to vanish. It means the world has already been diversifying slowly and steadily. And slow shifts in reserve behavior can matter a lot because the system is built on trust at the margins. You do not need a total collapse in confidence. You only need enough drift for the cost of capital, the value of money, and the behavior of institutions to start changing. One of the clearest signs of that shift has been gold. Central banks have been buying it at a pace the world had not seen in generations. They bought more than 1,000 tons in 2022, more than 1,000 again in 2023, about 1,045 tons in 2024, and another 863 tons in 2025. Those are not random purchases. Gold has no counterparty risk. That means it is not someone else's promise to pay. In a world where trust in promises is getting thinner, that matters. When central banks in countries like China, Poland, and Turkey increase gold reserves, I pay attention. When reserve managers diversify, even while the dollar remains dominant, I pay attention. And when wealthy investors begin talking less about maximizing return and more about preserving purchasing power, preserving optionality, and preserving access across borders, I pay even closer attention. These are not emotional reactions. They are adjustments to a world that is becoming less stable, less unified, and less forgiving of concentration. A lot of people hear that and assume I am telling them to hide in a bunker or dump every stock they own. I am not. That kind of thinking is just the mirror image of blind optimism. It is still emotional. The investors I respect most are not trying to predict one headline. They are building resilience for several possible futures. That is a very different mindset. It is calmer, it is more practical, and it usually looks boring before it looks wise. At Bridgewater, I spent decades watching how institutions think when the stakes are real. Pension funds, sovereign wealth funds, central banks, endowments, family offices with more money than entire towns will ever see. They do not sit around asking what will be exciting next quarter. They ask how to survive a world that might punish overconfidence. They ask what happens if inflation returns in waves. They ask what happens if supply chains split along political lines. They ask what happens if capital cannot move as freely as it did in the great era of globalization. That last point matters more than most people realize. For a long time, the world organized itself around efficiency. Make things where they are cheapest, ship them where demand is strongest, move capital to where returns are best. But once geopolitics becomes more important than efficiency, the math changes. Countries start talking about resilience, security, self-reliance, strategic industries, trade restrictions, and critical minerals. Those words sound dry, but in practice they mean the world is becoming more fragmented, more political, and often more inflationary. I have seen this movie before, just in different costumes. In the years before the old orders cracked, people always found reasons to believe the structure would hold. Before the British order weakened, London still looked powerful. The empire still seemed vast, but debt from wars, rising rivals, and internal strain were already eating through the foundation. The pound did not lose its special place in one dramatic day. It weakened through pressure, then shocks, then recognition. Most people only understood the change after it was already expensive to respond to. Would your portfolio still make sense if the next 10 years looked less like the last 20 and more like a messy transition between two systems? That is the question the richest investors are quietly asking. And their answer is usually not a single trade. It is a set of behaviors: less blind concentration, more geographic balance, more attention to liquidity, more hard assets, more skepticism toward long duration promises, more care around leverage. Leverage is borrowed money. It makes gains feel bigger when times are good, but it can destroy you fast when the environment changes. In a changing order, leverage turns small errors into fatal ones. I also want to address the biggest objection fairly because it deserves a fair answer. People say America is still the leader in innovation. It still has powerful companies, deep capital markets, strong universities, military reach, and enormous entrepreneurial energy. I agree. That is exactly why this is not a simple collapse story. Relative decline is not the same as absolute ruin. A country can remain powerful and still lose part of its dominance. A reserve currency can remain number one and still become less central over time. Those are not contradictions. They are how long transitions usually work. Another objection is that new technology will solve the problem. Maybe artificial intelligence will drive a productivity boom. Maybe robotics will cut costs. Maybe medicine, energy, and software will create enough growth to outrun the debt burden. I hope that happens. Growth helps. Innovation helps. But technology does not cancel political conflict. It does not erase who pays for deficits. It does not remove the tension between workers and owners when wealth gaps widen. And it does not stop rival powers from building alternatives to a US-led system if they believe it serves their interests. The hard part is that people keep trying to solve structural problems with cyclical thinking. A cyclical problem is a normal up and down move. A structural problem is built into the design of the system. If debt is too large, if interest costs are crowding out other spending, if internal politics make discipline nearly impossible, and if external competition is rising, then you are not dealing with a simple recession story. You are dealing with the end phase of one order and the birth pains of another. I also think many people underestimate how much money follows power. We like to believe markets sit above politics. In calmer times, they often look that way. But when the stakes rise, politics moves first and markets adjust. Sanctions change reserve behavior. Tariffs change supply chains. Wars change commodity flows. Elections change tax policy regulation and spending priorities. Financial rules can become weapons. Access can become conditional. In that world, investors are not just picking assets, they are choosing exposures to legal systems, political systems, and military realities. That is why gold has mattered again. That is why commodity producing countries matter more than before. That is why some investors want exposure beyond the United States without making the mistake of assuming every alternative is safer. Preparation is not about escaping one country and embracing another. It is about not being trapped inside one story. The biggest mistake I see is not choosing the wrong asset. It is becoming dependent on a single version of reality that worked in the past. If I sound calm while saying all this, it is because panic is useless. Panic narrows the mind. Preparation widens it. The investors with the most staying power do not prepare by making grand speeches. They prepare by asking what would hurt them most if they were wrong. Then they build around that. They know the future is never fully visible, but they also know patterns repeat because human nature repeats. So what might happen next? I see several paths. One path is a difficult but orderly adjustment. Debt keeps rising for a while, but growth improves enough and policy becomes disciplined enough to slow the damage. Inflation stays uneven but not explosive. The dollar remains the lead currency, though less dominant. Rival blocs grow, but open conflict is contained. In that world, portfolios that are balanced and patient do fine. Another path is the one I think many people still underestimate. The system avoids a sudden breakdown, but only by quietly reducing the value of money over time. This is often called financial repression. That phrase sounds technical, but the idea is simple. Governments keep interest rates below the true inflation pressure, directly or indirectly, so debt becomes easier to carry while savers lose purchasing power slowly. This does not feel like a crash. It feels like standing still while essentials get more expensive and your money buys less each year. Then there is the harsher path. Trade wars deepen. Capital controls appear in more places. Great power conflict intensifies. Sanctions expand. Supply chains split harder. Domestic politics become more extreme because debt, inflation, and inequality feed anger from both sides. In that world, markets can still rally at times, but the range of outcomes widens sharply. Wealth protection becomes less about chasing return and more about surviving regime shifts. A regime shift is a change in the rules of the game, not just the score inside the game. Which of those futures should worry you most if your money is still arranged for a world of cheap money, stable globalization, and permanent dollar calm? That is not a trick question. It is the question I would ask myself before I bought another stock, another bond, or another piece of property. Because the old habits were built in a special era. From the early 1980s through much of the period after 2008, many investors lived through a world where disinflation, globalization, and falling interest rates did an enormous amount of heavy lifting. Assets had a tailwind, debt looked manageable, supply chains kept costs down, the U.S. consumer stayed strong. That environment shaped people's instincts, but instincts built in one era can betray you in the next. So what does practical preparation look like? It starts with humility. I never want to be all in on one asset class, one country, one currency, or one political assumption. I want diversification that is real, not cosmetic. Real diversification means holdings that respond differently under stress. It means some liquidity. It means some protection against inflation. It means avoiding too much debt in my own life. It means understanding that preserving purchasing power is just as important as earning a return. For many people, that may mean a mix of quality, productive assets, some cash or short-term liquidity, some exposure to hard assets like gold, and some international diversification where it is sensible and understood. It may also mean rethinking what safety really is. A long-term bond can look safe because its price seems stable for a while, but if inflation surprises and the currency weakens, that safety can be an illusion. A stock can look risky because it moves around, but a good business with strong cash flow may adapt better than a fixed promise in a changing world. I would also watch behavior, not just forecasts. Watch whether central banks keep buying gold. Watch whether deficits stay massive even in decent economic conditions. Watch whether interest costs climb past $1 trillion and keep going. Watch whether global reserve composition keeps drifting. Watch how leaders talk about trade, sanctions, industrial policy, defense spending, and strategic resources. Those are not side stories anymore. They are the story. And I would remember something history teaches over and over. The people who lose the most in changing orders are usually not the poorest gamblers. They are the comfortable believers. They are the people who became so used to one system working that they stopped seeing its hidden costs. They confused familiarity with permanence. They mistook a long trend for a law of nature. Markets are very good at rewarding that mistake for years and then punishing it all at once. The richest investors are preparing for a different world order, not because they know the exact date of the turn, but because they respect the pattern. They know debt matters. They know reserve behavior matters. They know internal conflict and external rivalry matter. They know money moves towards safety, flexibility, and hard reality when confidence in promises begins to thin out. And they know that by the time the public calls it obvious, the best preparation has already been done. So if I had to leave you with one thing, it would be this. Do not build your financial life on the idea that the world will stay organized the way it was when you first learned how money worked. Study the incentives, study the debt, study the behavior of institutions that manage wealth across generations, not news cycles. And above all, do not confuse calm markets with a stable order. World orders do not usually die with a bang you can trade. They fade in trust, crack in pressure, and finally break in plain sight.